Silver sits at the crossroads of investment demand and industrial reality, and today it looks unusually relevant. In recent weeks, prices moved on a blend of inflation fears, central bank policy chatter, and renewed demand from solar panels, electronics, and medical devices. While gold headlines the chaos, silver often travels alongside it, offering extra leverage when risk assets wobble. Investors watch the metal for safe haven traits and for its role as a catalyst in technology supply chains. We are seeing renewed interest from hedge funds and ETFs as wallets shift toward real assets with balanced risk and potential upside in rising rates. Here is the simple version of silver today. It is a metal with two faces, a precious metal used in jewelry and a critical industrial input for electronics, photovoltaics, and medical devices. Its price is shaped by investment flows, mine production, recycling, and coin and ETF demand. When inflation jitters rise or real yields slip, silver often rallies as a cheap hedge. When manufacturing slows or the dollar strengthens, it retreats. In short, silver tracks risk appetite and growth expectations, while also capturing portfolio diversification through real asset exposure and its enduring industrial footprint. Policy signals influence lending and capex. Silver has lived in the shadows of gold for centuries, but its history as a money flag and industrial backbone makes it uniquely functional. The metal was prized in ancient coinage, traded on global markets, and then modernized by photography, electronics, and solar energy. In the 1970s, silver soared with inflation fears and all kinds of volatility, only to retreat as technology costs fell and mining expanded. In recent years, investors added silver to exchange-traded products, while independent producers chased new deposits in Peru, Mexico, and Russia. The interplay of jewelry, coin demand, and high-end manufacturing keeps silver actively moving. Market indicators show that silver is catching bid from both speculators and industrial buyers. ETFs have added hundreds of tons in the last quarter, and physical demand from jewelers and electronics manufacturers remains robust. In the futures market, open interest rose as spot prices traded around key resistance near $28 per ounce, while coins moved through central banks. The dollar's direction continues to skew moves, and rising real yields threaten a deeper pullback. Yet supply disruptions in Mexico and Peru remind traders that mine output is not unlimited, creating a ceiling for short-term declines and a potential rebound. Who is affected by silver movements? A wide range of players, including miners, manufacturers, and investors. Precious metal funds reallocate exposure when prices change, while jewelry producers adjust supply chains to secure affordable materials. Solar panel fabs and electronics contractors feel the ripple as silver thickness in conductors and high-grade sodas shifts costs and margins. Central banks and sovereign wealth funds diversify with bullion allocations, and retail buyers trade through ETFs and physical coins. Miners in Mexico, Peru, and China recalibrate capex, hedging strategies, and mine plans as prices swing, potentially delaying new projects or accelerating restarts depending on demand signals. Geopolitics and macro forces shape silver just as they do gold and oil. The metal benefits from supply resilience in Chile and Peru, yet risks disruption from policy shifts in emerging markets. Inflation, interest rates, and currency moves color investor appetite. A stronger dollar generally weighs on non-dollar-priced commodities, while stimulus and industrial demand lift metal usage. Energy transition policies drive solar installation and electronics production, fueling silver demand. Trade tensions complicate mine investment and logistics, and sanctions can alter supply routes for precious metals. In short, silver lives at the intersection of money, production, and politics. Markets monitor policy changes daily. Smart money is tilting towards silver as a hedged bet against uncertainty and a lever on inflation expectations. ETFs have broadened exposure, while bullion lovers shift weights away from riskier assets. Banks and asset managers show increasing interest in silver miners and in physical products as a portfolio ballast. Some funds rebalance toward industrial demand proxies like semiconductor capex and solar installations, while others trade on price momentum and option strategies. Retail buyers pile into coins during periods of market stress, reinforcing upward moves. The evolving narrative combines inflation protection with growth potential, a recipe for continued volatility and opportunity. Bear case risks center on a stronger dollar, a cooling global economy, and falling industrial demand. If rates stay elevated longer, investors may pull money from metals and into cash or bonds, pressing silver lower. A persistent lull in solar installations or a slowdown in electronics manufacturing could erode the backbone of silver demand. Supply updates from Peru and Mexico remain unpredictable, with mine disruptions or labor unrest triggering price spikes. Regulatory scrutiny of mining and environmental costs could constrain new deposits. Finally, competition from substitutes and changes in recycling efficiency could erode long-term pricing power. Risk grows with policy shifts. Retail investors can translate this into practical moves. Start with a small, diversified stake via silver ETFs or miners to capture both metal and production exposure. Consider layering in a physical allocation for a tangible hedge during market stress. Use trailing stops or conditional orders to manage drawdowns and protect capital. Track key indicators such as mining headlines, solar project approvals, and central bank signals to adjust weights quarterly. Avoid chasing dramatic spikes and maintain a disciplined rebalancing cadence. Most important, keep expectations realistic, align decisions with risk tolerance, and remember, silver accompanies portfolios, never dominates them. Patience and research outperform impulse trading. Looking forward, silver remains a multifaceted play on inflation, industrial demand, and investment sentiment. The metal could extend sideways in the near term, then break higher if solar builds momentum and jewelry demand stabilizes amid policy clarity. Risks include a stronger dollar, higher rates, or policy restrictions that dampen mining activity. Yet the upside path hinges on grid modernization, EV adoption, and new recycling efficiencies that reduce supply gaps. For patient readers, silver offers a hedge with upside leverage during risk episodes. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.